Let us do a quick revision. By now, you should be able to do things very quickly. Look at the following financial statements. How much cash was paid out for rent? You should be doing these things automatically by now, since all the logic should be easily understood. So what was cash paid out for rent? Pause and think. The answer is 340. Did you get it right? Please do not tell me you made a mistake. I will be very, very angry at you because you were naughty. And me, Mr. Extremely Huge Professor, does not like silly mistakes. You know what? Did you do a mistake? All right. I will hunt you. I will find you. And I will destroy you. Accounting should be perfect. Always. Let us put this in a formula. Payments is what I need to pay, factoring in that I have already paid in advance. And then I also pay extra so that there is an advance payment for later. Put this in the equation and you get that payments is 340. If we think of this in a cash flow perspective, the CFO of 160 equals to net income minus the change in prepaid rent. The change in prepaid rent always has a minus sign in front of it. The more operating assets you have, that means you have less cash. This is logical. If you have more assets, it is quite logical that you have less cash. This all ties together very sweetly. We received 500 of cash from revenues and we paid 340 for the rent. The difference is 160, which is the same number we got in the CFO. Let us do a big final revision. In front of you, you have an income statement and the balance sheet over 2 years. Calculate the cash flow statement from operations. So what is the final CFO balance? Take a pen and a paper and just do it now. Pause and think. The steps you have to follow are pretty standard. First, calculate the change in operating assets. The operating assets that you have are 100 for receivables and 100 for inventories. Next, calculate the change in operating liabilities. The only one that you have is wages, and that number is 150. Next, put it all in the formula. CFO always starts with net income. The first thing you do is add depreciation. Then remember, change in operating assets always has a minus sign. More assets, less cash. And the change in operating liabilities always has a positive sign. More liabilities, that means we have more cash since we have not paid our obligations yet. Put them all together, do the math, and the CFO is 50. The CFO is 50. What do we do with it? Well, we add it to the balance sheet. Please notice that the total cash last year was 300. We made new cash of 50 this year. So the total cash for the year is 350. Ta-da! Magic. See, it is so beautiful. When you are looking at a cash flow statement, whatever the final balance is on the cash made during the year, it always has to be exactly equal to the difference between the cash this year and the cash last year. It has to add up. This is accounting. Unless you are a Lehman Brothers accountant, there, nothing added up. They did not know what their assets are. They did not know their liabilities. Their accountants were all on vacation in the first 9 months of 2008. Do not be a Lehman Brothers accountant.